With the 2021 contribution deadline for your RRSP happening on March the 1st, I thought it'd be an awesome opportunity to talk a little bit about this registered account. I know on this channel we have definitely focused on the TFSA, but the RRSP in the younger generations gets a little bit of a bad rap. So I figured we could discuss what it's all about, how they work. We'll also be discussing the benefits and also the cons. We'll also take a look at where you can put some numbers in to see how it may benefit you in your personal financial circumstance. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for content just like this. We're going to start by looking at a website by planeasy.ca, and it talks a little bit of a high level of how the RRSP works. Now, I don't want to be caught in the nitty gritty. I'm hoping through the benefits and cons, we can get an understanding if this may be the right for you. And obviously, looking at the example at the end will be the best determinant. So, how they work. RRSPs are pretty simple. Contributions are made pre-tax and then they grow tax-free until withdrawal. Okay. If a contribution is made with post-tax income, then you'll get your tax back at the end of the year. When you eventually withdraw money from your RRSP, it is considered ordinary income and will be taxed at your marginal tax rate. So we'll figure out with the example what your marginal tax rate could be and what that number may look like in terms of, we'll discuss it a little bit later in the benefits. I don't want to give it all away, but it's definitely the marginal tax rate is the key component. And if you have a margin account and you're not utilizing the RRSP, then, it might be worth taking a look at this account to kind of supplement that. So RRSP withdrawals can be made at any point without penalty. And they go on to talk a little bit about, withdrawal and withholding tax. That's something that you should take up with a tax advisor, but let's just go over the theory as to why this could be good. So RRSPs can help you defer tax. You won't avoid tax altogether. You just defer tax until retirement. This is why RRSPs are especially popular with high income individuals. They can defer tax until retirement when they're in a lower rate. So with that being said, it doesn't particularly need to be all higher income investors. It's definitely as per your personal financial circumstance. So with that being said, it's an account that you can put money into where you can defer tax. You don't have to pay tax in the short run, but you would be paying it at a later date, but you're getting the growth. So if you're investing today, that money is going to grow over 5, 10, 15, 20 years, depending on how long you want to keep it in there without being taxed on a yearly basis if you're selling, especially if you're incurring that in a margin account. So let's move on to the benefits, the 6 benefits of the RRSP. So certain withdrawals can be made without paying tax. The most popular one is the first-time home buyers. They can use the home buyers plan. And then there's also the people returning to school can use the lifelong learning program. So these programs have limits on withdrawal and require repayment in a period of 15 years. So that is definitely one benefit. If you want to take out that money to buy your first home or you want to go back to school, that can be super important. Withdrawals can be made at any age. It's not like you have to have your money in there for a long period of time. It's not like, hey, I can't touch this money until I'm 60 years old. You can pull it out at any time. Just know that you're going to be taxed at the marginal tax rate. So marginal tax rate is based on how much income you have and definitely varies with that. The higher money, the higher income that you have, the higher the tax rate is. So do some homework on what your marginal tax rate. We can get an indication in the example of where you may be at. Contributions are a tax deduction. So this is probably the most important one for me. RRSP contributions are considered a tax deduction and will lower your net income. This can increase your income tested government benefits, this on top of your income tax rebate. So where I look at this is that if I take some after-tax income that I have been saving and I want to put it in, it will actually lower the amount of income. And we'll do this in the example later. But if I put a chunk of change down on my RSP that has already been taxed, I can go and reclaim that money back. So next portion is protection from creditors. A little known benefit, RSP savings are protected from creditors. This includes claims from lawsuits or bankruptcy. Just like your pension, your RSP can't be used to cover liabilities from either a lawsuit or bankruptcy. So it's interesting to see that if somebody is coming after you, they can't touch your retirement funds. Tax-free compounding, this is something we touched on before, putting this money in for multiple years and letting it rise without being taxed, without the tax man coming after you. Massive benefit for RSPs is that any investment made inside an RSP will grow tax-free. This lets your investment compound much faster without the drag of annual taxes. This can be super significant, especially when you're looking at the comparison again between the RSP or a margin account in which you are actively trading. Potential for lower lifetime tax rate. So along with the tax-free compound, another massive benefit of an RSP is that you can lower your average lifetime tax rate. Contributions made during high tax years and withdrawals can be made in low tax years. So basically the best benefit is that if you're making a lot of money now, or if you're going to be making more money in the next 10 years than you will at the end when you're close to retirement, then you will win. So hypothetically, if you're taking out $10,000 and you're paying tax at a 40% level because you hit that tax bracket, and then near retirement, you're going to be in that 28 or 26% tax rate, well, you've effectively dropped your tax rate by that amount. Your money can sit investing, compounding until you're ready to pull it out, and effectively you will be making less money. And when you're making less money, you're being taxed less by the government. That is basically the key benefit to an RSP, is that you're deferring tax to a time period where you're probably going to be making less money. And when you're making less money, you're paying less tax, and effectively you are putting more of that money in your pocket. So now we're going to take a look at some of the drawbacks. So withdrawals are considered ordinary income. When we talk about a margin account and we talk about investing in Canadian companies, sometimes they give preferable tax rates on the dividends. So that's one thing that you would definitely not benefit from, because of the fact that they're considering any portion of income or pulling out is going to be taxed at your marginal tax rate. So that's something to consider for sure. Dividends from Canadian companies and capital gains receive special tax treatment outside of the RSP, but if they're held in the RSP, this won't happen. Money earned in an RSP is considered ordinary income when withdrawn, and that gets taxed at your marginal tax rate. So something to definitely consider. Withdrawals will impact income tested benefits. So if you're looking to get OAS or GIC, due to the high clawback rate of 50% on the GIS, this is a big drawback for very low income families. So something to take into consideration for your own personal financial situation. Contribution is a scarce resource. So the RSP contribution will never come back. Unlike an RSP, if you're 18 in that year, you can contribute to that level. If you haven't seen my TFSA video, I'll link it above. But you can basically contribute to all of the available room that they've allocated dating back years until you were 18 years old. The RSP is a little bit different. The RRSP is only, you can only contribute for the previous year based on the income that you had. So contribution room is based on income. Contribution is based on your gross income. In a low income years, you accrue less contribution room. TFSAs, on the other hand, always accrue. Less flexibility to share contribution room. Their spouses cannot contribute to each other's RSPs. RSPs can only be made with your own income. So there's often ways that you can, if you're the higher income spouse, you can share over some funds and get some tax benefits that way. With the RSP, this is not possible. So mandatory withdrawals at the age of 72, you have to pull your money out at that time, and then it will be pulled out on a percentage basis throughout. So the tax refunds that you get after you put your after-tax money in, this cannot be spent. This money is definitely needs to be saved, and we'll show you a little bit about, you know, how much money that could potentially be. So those are some of the benefits, and there's definitely some cons or definitely some disadvantages when it comes to it. It just depends on your personal situation and where you can find your RSP deduction limit, because it's based on your income, is on the form T 1028. So that's where you can find it, and that'll show you how much you have in the previous year's contribution limit, how much you can put in there. So next we're going to take a look at an example, and what I've done is I've gone to this website, wowa.ca. I'll throw it down in the description. I put in Ontario just for an example. Employee, the 2022 year, for an example, I put in 60,000 with 0 RRSP contributions. This can obviously be tailored to your specific situation. And at the bottom, it shows me the results, how much I'm going to pay in total tax and what my after-tax income is. It also shows me my marginal tax rate of 29.65 down here. So what we'll do, just for an example, is we'll take a look at this total tax. So the 14,591. I'm going to go ahead and throw this in a calculator. And then what I'm going to do is I'm going to open up a separate browser. I'm going to put in the same information. Instead, this time, I'm going to put in my income deduction of an RRSP contribution that I had of $10,000. Obviously, we see the March 1st deadline is posted here. So when we see the results, it's a little bit different. We see the total deductions has now included this $10,000, and it's effectively dropped my total taxable income to $50,000. And what does that do? That drops my total tax. We can see the total tax here is only $11,000. So what does that mean? That means that this original $14,000 that I'm paying will be reduced if I contribute $10,000 to my RRSP by approximately $2,965. So we can see here that the by putting $10,000 of my after-tax income into my RSP, that will drop my tax. I won't have to pay almost $3,000 worth of tax right off the hop. So definitely fool around with this. Put in your personal information. See if there's a number that makes sense to you in terms of what can I afford and what will that do. And remember, don't spend this. This is not spending money. Use this to either invest or put towards your TFSA. This is definitely free money, and we should be taking advantage. But I hope you enjoyed the video. If you're still here with me and you got some value, hit that like button for me. I hope you enjoyed it. Have a great week in the markets. Happy trading.